Hey everyone, thanks for joining this video. In today's video, I'm going to go through 17 stocks that are down pretty big over the last week in the stock market here. We're going to cover both Canadian and American stocks that have gone down. The objective of this video is just to share some stocks that have gone down disproportionately to the market to maybe incentivize you guys to put some of these on your watch list, do some more information, or just become aware of new public companies in the market. So we're going to go through each of these pretty quick. If you like this kind of content, be sure to subscribe to the channel, give this video a big thumbs up. It does help with the YouTube algorithm for me, so I do appreciate it. Now, I'm just going to touch on, before getting into these 17 stocks, the fact that the broader market is down a lot over the last week. So the Dow dropped another 300 points today on Tuesday, but the S&P is at its lowest level since June. So we're at like a 4-month low, mostly driven by some weak economic data, but also behind some sentiment coming out of the Fed in the US of interest rates being a bit more pesky at these higher levels, may even go up further if they don't see inflation drop and whatnot. We also have oil prices that are high. That puts a lot of operating pressure on lots of businesses. So lots of headwinds and pressures for the economy, for the consumer. And that's kind of led to a trade-off on equities, as you can see here today at the top of the screen. So with that backdrop, we're going to go through these 17 companies who've had disproportionate hits to their stock prices, talk a bit about their businesses, their valuations, and whatnot. The first stock, as you can see on the screen, is Shopify. So Shopify's down 11% in the last 5 days. You can see their charts just kind of trended downwards, now at a $90 billion valuation here. Looking at Shopify longer term, you can see it's still done phenomenally well, but still way off of its let's call it all-time highs during the pandemic. You can get it at a 2/3 discount at these levels. So Shopify, my thoughts on Shopify just broadly and generally are they have a lot of great businesses. They're invested and have a lot of exposure to direct-to-consumer businesses, e-commerce. They're also expanding their in-store networks for payments and services to small businesses that have storefronts. So I think Shopify is a great business. In terms of profitability here, we'll take a look. You can see they edged out a brief profit there, but they've really been reinvesting in the business. Looking at the business annually here, other than 2021, where they had a huge income and net margin there, almost $3 billion on 4.5 of revenue. They've pretty much gone back to investment mode, burning through a lot of cash here. I think that may be part of the reason, especially with interest rates as high as they are, that the stock's down, just not really having a price to earnings multiple and less appetite to trade on a revenue multiple in this environment. But also just the fact that this is still a growth company. The profits are farther out into the future. So in the net present value of the company, it does come down when the outlook looks less rosy for revenue growth, economic growth, interest rates staying high. Lots of those things are pressure for Shopify. So they just kind of fit the mold of the companies, the type of tech companies that are disproportionately hit by these developments in the market. Going on to stock number 2 here, it is Dollar General. So Dollar General down 7% here. If I look longer term, this one is getting killed, down 30% in the last month, 50% in the last 6 months. 56% year to date. So this one's currently trading, I think, at a future PE of around 12, whereas historically it was trading at a future PE of like 25 because the amount of growth that they were delivering over the longer term here. So you can see they've done really well longer term, but in the medium term here, even since 2018, they're flat. And you can see over the last 5 years, all of their gain that they accomplished has been wiped out in 7, 8, 9 months here. And what's behind this is, for the most part, it seems like their consumer, which is lower income consumers in America, in Mexico, have been disproportionately hit by lots of the cost of living increases, inflation, things like that. No longer buying as many goods, no longer buying discretionary goods as well, which has been a huge headwind for their business, their same store sales growth, their new store growth rates in terms of stores they're putting up. All of these things have been impacted by the macro economy for Dollar General, which is really interesting. You kind of think of Dollar General as a dollar store, but it's really not. Dollar General is mostly located just in areas that don't have a lot of other not restaurants, but grocery stores and things like that. And they kind of fit that niche and fit that gap in the market in those more rural or more out there locations, right? So they don't necessarily only sell cheap things. That's just the name of the brand, the name of the store. So try not to think of them like a Dollar Tree or a Giant Tiger or something like that. This is a retailer that sells an array of products, including discretionary goods, and they just happen to serve generally lower income consumers in those areas, disproportionate to lots of the other national retailers. And their consumers getting crushed, you can see, has had an impact on what they're buying, how much they're buying, and how deal oriented they're buying for the stock to go down this much in the last month and the last week here. Going on to the third stock here, it is BCE. So this is Bell, the telecommunications company in Canada. They have Bell Media that you're probably familiar with their cable offerings. Pretty sure they're the biggest cable company in Canada. Also have wireless services, internet services, stuff like that. This company down almost 5% in the last week, 15% in the last year. You can see the dividend yield approaching 7.5%. So this company has a huge yield. I don't think they've ever cut their yield before, and I think they used to be increasing it every year. Maybe they still do, but just by like a percent or so to keep the streak alive. But they've had a lot of challenges. These companies have a lot of debt in the telecom space. Two of their competitors, Rogers and Shaw, just merged, which may provide more competition in certain markets like out west. So it'll be interesting to see how it plays out, but definitely astonishing to see a 7.5% yield on a huge Canadian company that historically has done really well, like Bell here. The fourth stock, I'm just trying to go through these quick so I don't keep you here all day, is Diageo. Diageo down 5.5% in the last week. In the last month here, down about 10%. This is the largest liquor provider in the world. They own lots of brands like Grey Goose, like Casamigos Tequila. They also own Guinness. They own tons of businesses in that alcoholic beverage space. You can see here, pretty big market cap, $84 billion. But they've experienced a lot of weakness in their stock price, now down 10% in the last month. I don't think they reported an earnings report here in the last month, so this is all just maybe sentiment of less people buying premium liquor, which is really what they're trying to push more and more into. They have Blue Label, they have Black Label. Obviously, Grey Goose is a pretty premium brand and stuff like that. So as people maybe don't buy as much liquor at all or begin to buy just cheaper liquor, being more deal-oriented or whatnot, that may impact their business results. And it seems like investors are starting to adjust for that in the stock price with how the stocks move down here over the last week and month. Next stock here is Brookfield Asset Management. So Brookfield Asset Management, for those in Canada, probably know this company pretty well. You can see here in the last week, they're down about 6%. They've held up fine over the last month, so it's just a bit of a reversion. Pay a yield of 3.8%. They own lots of like private assets that they raise money from investors, obviously pay the investors their return as they sell those assets and get cash flow from those assets. And then they take a management fee. So similar to like a hedge fund or a private equity firm, they'll have management fee structures in place. So very high margin business for them just to take management fees. They also invest, I believe they invest along hand lots of their private investors through some of their other holdings, like in Brookfield Infrastructure Fund or their property fund or whatnot. But for the most part, they don't have a ton of scale in those investments. So lots of it's just margin and that they're getting from the management fees they're deriving as long as they continue to bring investors good opportunities. I think one of the concerns maybe in this space is with interest rates as high as they are, alternative options for cash like GICs or whatnot to make 6% interest. Maybe there's a bit less private capital going into these private deals, or maybe a bit more hard to source capital to then derive fee income from. So maybe that's part of it, but I don't know the business too well. That's just a hypothesis they haven't done too bad longer term. You see here in the last year, they're at a slight gain plus the dividend. It's really just this dip, 7% or so we've seen in the last week here on Brookfield Asset Management. But who knows? Maybe if you were watching the stock or were previously watching the stock looking for a dip, this may be the time to look into this one again. Going into the next stock here, it is Aritzia. So obviously a clothing brand, retailer, originating in Canada, now expanding heavily into the US. They're down about 5% in the last week, 13% in the last month, and they had a poor earnings report, so down 44% in the last 6 months here, over 50% down on the year. So this was a high-flying stock during the pandemic. You can kind of see it skyrocketed up to $50, $60 a share as some of their products and brand became very popular in the US. They had a huge US growth strategy. I think they still have that strategy. They're just having a hard time being as productive at a store economics level as they used to be, and maybe see a bit more challenges in front of them than they did when they were expanding during the pandemic. So that's definitely taken a pretty big hit on their valuations. We see here trailing P of about 14 times, $2.4 billion company. They are profitable every quarter, which is nice to see. 18 million of profit there, 37, 70, 46. So they're a bit all over the place as they continue to focus on revenue growth, and they've done a pretty good job of that. 850 million to 1.5 billion, almost doubled, and then 2.2 billion. So they're still in pretty fast growth mode here. They did $2.2 billion last fiscal year, and the current market cap is $2.4 billion. The $2.2 billion was a revenue number, obviously. So they're trading almost at 1 times revenue, and they're growing pretty nicely here. But this is a business that if the economy does take a turn for the worst, they may have a lot of struggles in holding that efficiency and productivity of sales per store. They're taking on a lot of expenses to build out this store infrastructure across America as they continue to expand their boutiques. So we'll see how it plays out. I see this as a bit of a risky one, but if they do hit it and the model does work and they scale it, could be a ton more upside than $2 billion for Aritzia, given the traction that they have the potential to have in the US compared to, given how well they did in Canada. So this is an interesting one, definitely a riskier bet. No dividend on this one either, but they are profitable. They have had a proven model in Canada at least, and you're pretty much just betting on if they can stick that model in the US, which is what they're trying. Will they do that successfully? If so, I think 5 years from now, stock will be way up. If they don't, they'll have a lot of restructuring charges. It'll be a mess, and the stock will probably go down. So that's essentially the bet you're making with this one, in my opinion. Going on to the next one, PayPal. PayPal down 6% here in the last week. PayPal's had a disastrous year. Look at it over the last 6 months here. Oh, getting frozen a bit. Last 6 months down 20%, year to date down 21%. If I go past 1 year here, we're down 30%. So this company's trading at a pretty low PE. I think their forward P is around 12 or 13 times. They've had lots of issues with their eBay, which used to be partnered with PayPal or owned with PayPal, going into their own payment software. So kind of throwing PayPal to the side. That's been a bit of a headwind for them over the last few years. Lots of new competition coming on board that investors are worried about. But they're making billions of dollars a year still in free cash flow. Going down to their earnings here, you see that every quarter they're pretty much making $1 billion, give or take. So on an annualized basis, last year was 2.4 billion. The year before was 4 billion, and it looks like they're still making $1 billion a quarter. So if they make $1 billion a quarter, they're trading at about 16 times free cash flow right now. They buy back tons of shares. Historically, they were trading at 20, 30, 40 times earnings. Currently trading at, I think, 12 or 13 times forward earnings. So once again, you're betting on them being able to bat off competition, continuing to hold their business at least flat, but hopefully with some growth, buying back lots of shares to increase your ownership stake in the share price in the company. And this one does look like it's a decent value, but it's a space that I'm not too familiar with. They have a lot of other competition like Block as well with Cash App versus Venmo. Let's take a look at their stocks. Similarly down pretty big. All these stocks got pumped up like crazy during the pandemic. You see here, Block going all the way up to $270 a share. insane, bigger than like lots of big banks in terms of the market cap they were at. So some of this is just coming back to life probably, or coming back to reality on PayPal and Block, but maybe some additional opportunity on the surface as well if they can keep pumping out, or PayPal can keep pumping out the earnings that they have historically. On to Moderna. Moderna down 7% here in the last 5 days. In the last month, down 12%. Year to date, down 17%. So lots of these have just been trending down now. $37 billion company, more than half or less than half what it was at the peak in the last 52 weeks. I don't really mess too much with these pharmaceutical companies. Not my area of expertise. Don't really understand the space overly well. Lots of expiring patents, new studies, stuff like that. I do own a cover call ETF called Life, which holds lots of these things. And I just rather have some exposure to the overall sector than going picking names in a space that I don't know. But I did want to call out that Moderna was down a notable amount in the last week here. A stock that I do own, Canadian Utilities, getting hammered today. So you can see they got some hold calls from analysts, whatever that's worth, down just over 5% in the last week. In the last month, down closer to 10%. This one's now trading at over a 6% dividend yield, and they've increased their dividend every year for over 50 years. So if they continue that trend, getting a starting yield on cost of 6% could potentially be really high yields on your initial investment 5 years from now, 10 years from now. There's obviously risk associated with the assets they own, with the debt they have, with interest rates, what they are, et cetera, et cetera. But all of investing is really just risk reward. So you got to balance the two against each other. This is one I haven't looked into for a while. So not one I'm currently investing in, but maybe as it continues to go down, I may revisit their last couple earnings calls and whatnot to just get a sense for what's going on with the broader business and what they're projecting for next year, to see if this may be an opportunity on one of my stocks to add more of. Going into the next stock here, it is Realty Income Corp. Realty Income is another stock I own, and I'm getting hit hard this week, down 7% in the last 5 days, over 10% down in the last month. And it totally makes sense that real estate stocks are getting hit given the higher interest rates, given some of the consumer pressures. So definitely understand this one. I just think huge company here, $36 billion market cap. They're paying out about a 6% dividend yield at these rates, trading at like a 12.5 times funds from operation multiple for super diversified REIT, both in where they operate and who their tenants are, and the type of real estate they own increasingly. So I think they'll, if any real estate owner can weather the storm through a bad recession, even if we have one, it would be a company like Realty Income. So I think by holding on to this one, I think the equity will be safe in my opinion, just because of the sheer size and amount of dollars they have coming in, the amount of safe tenants they have. Will the stock price go down further? Hey, maybe. I don't know what's going to happen with interest rates in the economy. But I do think that 5-10 years from now, they'll probably keep paying their dividend every month at the level it is or higher as they continue to increase it. And I think the equity will hopefully be worth more at that point. Interest rates, in my opinion, will eventually have to go back down somewhat. And I think at those times, these REITs are all gonna fly. So I'm actually taking this opportunity to buy more Realty Income over the last couple weeks, and interesting to see if the stock breaks through new 52-week lows into the 40s. You can see here it's right at a 52-week low here today. Next stock I got here is Magna International. This is a car parts company, big business, $20 billion here, pays a nice 3.5% dividend. Down about 5% on the week here. Longer term in the last month, down 6%. Year to date here, down 7%. So not down too much, especially given you've gotten that dividend yield, but still some weakness on this one. It had a high of over $90 on the year. So interesting diversification if you want to be in the automotive space but don't want to buy a car manufacturer. This is another potential option that you may want to consider. Into the next one here, 3M. 3M down 6% in the last week, 10% in the last month, 16% in the last year. The stock just keeps going down and down and down over the last 3-4 years. You can see here they're at $220. We had a bit of a comeback there, but now down, 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 down. So down about half in the last 5 years. You have gotten a pretty good dividend yield. They've had a lot of legal disputes and legal issues, lawsuits, settlements, stuff like that on lots of their products. So because they're in that space and they've had those issues and they're just kind of all over the place, it's one that I've avoided investing in here, and it's a good thing, at least for me, to not be have not been invested in over the last few years. But hey, if it was something that you guys wanted to take a gamble on or were looking at adding to, you're definitely getting a bit more weakness here as the stock approaches kind of 52-week lows at $90 a share. Next stock here is Warner Brothers Discovery, down 9% in the last 5 days. You can see them down 25% in the last 6 months. It was interesting when I first pulled this one up because I think the writers or the actors just solved their strike. So I thought, if anything, this one would pop a bit, but maybe that just means incremental investments for content. I would have thought that would be obvious, though, given that when the strike was done, or if the strike's done, it's going to require increased investments in order to get these shows up and running. But ultimately, that's the business they're in. In the last year, this one's down 6%. Last 5 years, so since it went public or split from AT&T, down about 50% here. They took a really bad time to spin off a company with tons of debt on it and not a lot of operating income in a sector that was in secular decline. So lots of things going wrong with Warner Brothers Discovery. With that being said, the market cap, given the value of their assets in isolation, is really cheap. So $26 billion on equity. I think they had like $40 billion or something in debt. But once upon a time, the Warner Brothers Discovery library, even before they merged with Discovery, when it was just Warner Bros., was being valued at like $100 billion. So a lot of underlying value if they're able to come up with business models through like entertainment and distribution that can support it and turn to profitability, overcome those debt obligations they have, slowly pay that off. But you'd really have to be in this one for the long run because they have a lot working against them with the decline of cable and a lot of things to achieve at the same time as paying off that huge amount of debt that they have sitting on their books. The next one here is Amazon, down almost 10% in the last 5 days. In the last month, not down as much, just 4%. Year to date, still up huge. So I don't have too much pity for my fellow Amazon investors. But yeah, it's definitely not been a great week. I don't know if you guys saw the news, but there's lots going on with Amazon. FTC is coming after them, as FTC is coming after every big tech company, it seems like. Amazon also recently invested $4 billion to buy a part of an AI company as well. So that was an interesting move as kind of, the buzz topics of AI spread across the tech landscape. But really, like, lots of the top companies are investing a lot more in AI, whether they're doing it internally or externally. Amazon here is making an acquisition, but I'm sure all the other tech companies that aren't are investing billions of dollars probably internally trying to build the same capabilities. So I don't really know how to size up that acquisition. Obviously, in the grand scheme of the company, it's not huge given the amount of revenue and operating income Amazon makes on an annual basis. But it was interesting to see that they're making sure they're not going to be left behind in that space, and they see opportunity to drive efficiencies through AI in their operation. But yeah, Amazon down 10% on the week. Out of these stocks, the smallest violin playing for them is they're still up about 50% year to date. Next stock here is Alphabet. So Alphabet down 7% as well on the week. As I go to longer term periods, last 6 months still up 25%. So similar story to Amazon here. Like I said off the bat with Shopify, lots of these multiples are just getting compressed because of the type of companies that these are. Higher growth companies, when interest rates are higher, impacts the net present value of the equities. And we're seeing that come across just in the performance from the last week. But over time, that usually smooths out. And these companies long term, as you can see here, have done amazingly well. So I try to not get too concerned over these periods of time. The second last stock here today is Air Canada. So Air Canada is down about 6% in the last week. In the last month, you're down 15%. I think I saw they're expected to do like $4 of earnings per share this year. So that would give them a 4 to 5 times price to earnings multiple. They even paid off some debt. But I think there's a lot of concern in the broader aviation space coming out of the U.S. Airlines, that some bookings for next summer are coming in lighter, pricing's coming in lighter, fuel continues to go up in price. All these strikes and whatnot with pilots continue to be a hot commodity, getting paid more than ever before, and lots of wage pressure there. So lots of costs going up. And while they were making money hands over fist this past year, it seems like general sentiment is that that Goldilocks phase is coming to an end, and next year will be much more challenging, and that's kind of starting to get priced into these stocks, including the Canadian ones here with Air Canada. And the last stock here is Microsoft, very similar to the sentiment just on these higher PE companies getting a bit revalued here, down 6% in the last 5 days, only 4% in the last month, up 30% in the last year, as they really have been firing on all cylinders, investing in AI, leading with AI, all the integrations they're making across Bing and Office 365, the Activision Blizzard deal that should be going through any time now to really bulk up their gaming division. They just got tons of great stuff going on, and that's really shown in the stock price year to date. So if you were looking at, buying on a bit of a nibble, saw the stock up at 340 and looking for it in the low 300s instead, maybe worth reevaluating here, but just wanted to flag that even the big dogs like Microsoft, Amazon, Google also having pretty crappy weeks here. So those were 17 stocks in the stock market that have been underperforming the market over the last week, maybe potential buying opportunities or companies worth adding to your watch list. Let me know in the comments if you own any of these stocks, if you're watching any of these stocks, if you have any thoughts or comments on any of these stocks. Would love to hear from you guys. If you guys made it to the end of the video, thank you so much. Really appreciate that. Be sure to give this video a big thumbs up. Subscribe to the channel if you haven't already. We're on the chase to 1,500 subscribers here. And be sure to see me in the next one. See you guys. Bye.